Hello and welcome to Money Talks, the program that helps you grow your wealth, whether it be through stocks, property, other investable assets, or by growing a business. And we kick off a new series where each week I will corner hotshot fund managers who manage other people's money to see how they invest their own money. Tonight we'll get an inside mail from Aitken Investment Management's very own Charlie Aitken, plus the fallout from the Banking Royal Commission and some preemptive measures that are already impacting the self-managed super fund sector. And we'll tell you about a stock that can keep your portfolio on a healthy high. But first, he's arguably Melbourne's most successful youngest property developer. Let's meet the man who's helped us to never forget something called smashed avocados. Anyone driving around the cities of Melbourne and Brisbane undoubtedly have seen huge apartment complexes under construction with the name Gurner on the signboards. Well, the man behind this fast growth business is Tim Gurner, and he joins me live in the studio. Welcome, Tim.
Thanks, Peter.
Now, we'll get to avocados later. It's a sidebar to your great business story. How did you get into developing?
Look, it's a bit of a winding story, to be honest. So when I was studying, I wasn't very good at university, got to be honest. I got a bit bored, so went part-time and started with a real estate agent first, actually, a guy called Tony Pride. It was an amazing experience for me, learning how to market, how to sell, and it was a really important part of my life, to be honest. And after that, I started my first business, which was a gym in Elwood.
What was that called?
It was called My Wellbeing, actually. Yeah. So great little business and really learned a lot. I learned a lot more in the first 6 months of that than I did in 5 years of university. But and then I ended up at a company called FKP, public company. Definitely wasn't suited to me. I wasn't very good at being told what to do. And then I approached a guy called Maury Schwartz. So Maury was sort of the
Melbourne property baron has been described as.
Yeah, look, he was, and he's an incredible person, a very humble and been a very important mentor for me throughout my life. And so I started with him. And
but you did a gutsy play there, didn't you? You went in there and actually asked him for a job, didn't you?
Yeah, I did. Look, I called him up and said, look, I think what you're doing is pretty amazing. Can I come and see it? And he said, sorry, mate, who are you? And but look, I got in front of him and it was amazing, and he's still a very close friend and mentor of mine today, and I learned so much from him.
All right, now a lot of people watching this would wonder how you impressed him. Did you prepare for the meeting?
No, I didn't really, to be honest. I think sort of my benefit has been I'm totally obsessed with what I do. As you know, like it's a bit of a, it's pretty brutal having your own business, whether you're a coffee shop owner or doing what we're doing, and you've got to absolutely love what you do. And I'm very fortunate. I'm obsessed with design. I love creating things, and I really sat down with Maury and explained that. I told him what I liked about what he was doing and why I wanted to work with him, and the fact I'd work for nothing kind of made it a little bit easier to get a job.
Now, but so in a short time, sort of a JV you were doing with him, you got 5%, and within 2 years you had a third of the business. What do you think you brought to the table that impressed him, such he would want to offer you a third of a JV? Look,
I think what Maury was amazing. Maury was incredible at picking people. So he was an amazing creative, and then what I was quite good at was being absolutely dogged. So I just worked my ass off 24/7, 7 days a week, and did the bits that he wasn't doing anymore. And I think I added a big part to the business that allowed him to do what he was good at and let me drive it really hard.
Okay. That was what, around
2003, 2004?
Okay.
Actually, yeah, 2004, yeah.
Now, my research says on the rich list you're now worth about $473 million. Because some people laugh when the papers try and guess what they are, but clearly you've done well. And at one stage you sold, 1,800 apartments in a year, and Harry Triggerboff said, no, I'm the guy who does that. What did Harry say to you when he got to meet you?
Yeah, it was amazing. I went and saw Harry, because obviously Harry's the
guru,
the epitome of our industry, and there's no question about that. And I sat down with him, and I walked in first. He said, geez, you think you're pretty good, don't you? I said, oh, what do you mean? He said, well, I'm the only one who sells 1,800 flats in a year. I said, oh, look, I'm sorry, we've had a really good year, And but look, he was amazing, and although I only got about 15 minutes with him, it was a pretty amazing 15 minutes. And just to hear from someone who's done so much, it was incredible.
Yeah. So, but Tim, your point of difference, you have actually gone for a point of difference, haven't you?
Yeah.
You're not going for the high turnover apartments that you build them up, sell them off. Tell us what your point of difference is.
Look, I guess when I started Gurner, the brand, it was trying to do something a bit different in the sense that I wanted to create a luxury brand. So I didn't want people to just be buying an apartment from us in Brisbane or an apartment in Collingwood. I wanted them to be buying a Gurner product, which had a set number of rules. So had to have point of difference, own occupier targeted. You know, although it is own occupier target, we sell to a lot of investors. So a lot of investors who want to then go and sell to own occupiers down the track. Yeah. So always trying to create point of difference. And, you know, again, going back to what I love, you know, I'm obsessed with creating things. Yeah. So for me, whether it's creating a 6-star hotel feel or a very high-end own occupier boutique building, or going to something that's very meat packer-esque, for me, it's about creating things with constant point of difference. So we're pushing our teams and design teams every day to look at how do we do it differently, how do we do it better. We have a lessons learnt on every single project. We still get a lot of things wrong after 13 years. Yeah. And it's always about trying to get better every time. How
have you learnt to impress the banks? Because that's always a developer, apart from Harry, but Harry's been in it for a long time. Yeah. Developers have to have a bank on site. How do you manage that?
Yeah, I've got an amazing relationship with ANZ. I actually, for the first time ever, can say I've got a banking relationship in the past 10 years. And I think it's, you know, multiple things. You know, it's about telling the truth, you know, day one. So, you know, acknowledging when you know there's upcoming problems. You know, the Brisbane market we knew was going to be a potential risk in the last 2 years. Yep. Very upfront with what we thought was going to happen, and always trying to over-deliver on what their expectations were. So if we set a goal for sales or set a goal for settlements, making sure that we beat that all the time. And you know, I think it's just, you know, about seeing what they need and seeing what I need and working together. And I've been very lucky with the banks, and we only fund with the major banks. We fund with NAB and CBA as well. So I'm very fortunate in that sense at the moment.
And the projects going forward, I know that you've got a great one in Collingwood, which you've basically got an entire strip with a pub either end. We do, but the St Kilda one's a pretty special one too, isn't it?
Yeah, look, they both are. So Wellington Street Victorian Vine, which we'll launch at the end of the year, is a 200-metre front site in Collingwood on the edge of East Melbourne. And we've gone and replicated a street in Greenwich that I'm a little bit obsessed with.
So, I mean, the meat packers are...
Yeah, the meat packers. So although it's a big project, it's actually all about the detail in the project. It's a highly intricate building with beautiful exposed brick and metal frame windows. You know, something that will be really special for Melbourne. And then St Kilda, the old Novotel site on the water, we're going to be doing something very, very special there. So that's an ultra-luxury project.
One last thing, we mentioned avocados.
Of course.
You were interviewed on 60 Minutes and they sort of took one thing out of context. Yeah. Where you bagged millennials for having too much expensive coffee and avocados. Yeah. Do you regret ever saying that, Tim?
To be honest, no, I don't. Look, it was good. It started a conversation that probably needed to be had, and it was very much taken out of context. My conversation was much more about the European holidays, the BMWs, the new mobile phone, the new iPad.
The really expensive stuff.
Correct. Yeah. But you know what? I don't regret it. It is what it is.
Okay, if people want to know more about you, what's the best website to go to?
Probably is www.gurner.com.au.
Mate, fantastic. Thanks for joining us on the show. Mate. Very impressive performance and a great history so far. The nation's lenders are already taking preemptive measures to fix issues from the Royal Commission's interim report. And when all the dust settles, we could see a vastly different banking system. For more on this, here's James Kirby, who's the wealth editor for The Australian. And I had lunch with him about 2 weeks ago.
Well, look, I think there's probably three things that he actually really highlighted and made very clear he wanted to have a look at. One is, of course, this something of a farce, really, in the way that people fill out their household expenses when they're applying for a loan. It sounds like a bit of bureaucracy, but it's actually very important because, of course, it actually is the whole stability of the banking system is behind that. Mortgages is the biggest part of banking in our big four banks and how people apply for them. They put this document in front of the banks called Household Living Expenses Sheet, and you fill out what you think you spend each month. And they either take that figure or they take a benchmark, this housing measure done by the Melbourne Institute. They're both, of course, low, and it's been shown regularly that they're not accurate, and people are basically getting bigger loans than they can afford, and the documentation allows them to do that. So I think that will come under the focus, and that will, I would imagine, be changed, and they'll be much tighter. That means banks will have more compliance for sure, and people won't be borrowing as much. A second leg is this, the commissions, of course. We all thought commissions were gone for 4 years. They weren't. There was a grandfathering, or if you like, a residual arrangement left in there, and the banks exploited that terribly, and I think that will go. Which is that for sure will go coming up. And the other thing that they're looking at, I think, is more broadly just looking at when we look at how people apply for loans. I mentioned mortgages, but you see that the banks even now are doing some preemptive clampdown on SMSF, self-managed super fund loans, mortgages. Instead of waiting for the government to close them down, the banks have actually closed them down. The big four banks and AMP have gone out of the business, one after another, consecutively in the last few weeks. So I think you're going to see that sort of thing happening more often, where the banks actually will move first when it suits them. And for some reason, it seems to suit them on SMSFs. It's not clear why, actually, because you would have thought SMSFs were a good bet. But then, of course, we saw some terrible abuse going on in the way that they were sold in the Royal Commission as well. So they're the three things, I think, in terms of that you can grab onto that the Commission is going to change pretty soon. Well, remuneration is the issue all the way through the banks. How are people paid, and in what way does that does their behaviour link with how they're paid? And it's not just at senior levels; it's right through the banks. From the time you walk in and hit the counter in a branch till you get to the very top of trading desks and executive level remuneration. This whole system of bonuses, that it's become a sales culture. It's become banking is about the sale of bank products. That has to change. It really has to change. It wasn't always like that, and I think we will see the Commission moving in on that. That is something that the banks individually will find really hard to take, and no bank executive at any level wants to be paid less than they are, or bring home less than they bring home, which is really what it's about, because it's the bonuses, it's the commissions, it's the part where you get a kicker on your salary because you sell bank products. That's the bit they're going to zone in on. That's the bit I think where we'll see a real fight.
That's James Kirby, the wealth editor from The Oz. Coming up, a top pick in the healthcare space with Julia Lee, plus one of Australia's top investors puts his money where his mouth is. Welcome back to Money Talks. I'm Peter Switzer. The healthcare sector has been the best performing since the GFC. Okay, in the past 10 years, it's seen a return of almost 250%. But with big moves on the upside and downside, how do you sort the diamonds from the rocks? And is it too late to cash in? Let's see what Bell Direct's Julia Lee has to say. Julia, thanks for coming on the show.
A pleasure, Pete.
Okay, let's just talk about the sector generally. It's been a really good performer, hasn't it?
It's been a fantastic performer. I mean, big giants like CSL up 400% over the last 10 years, ResMed up 500%, Main Pharma up 600%, Nanosonics up 1,800% over the past 10 years. But anyone who knows this space knows that you can also lose a lot of money. It can be a big hole which sucks in your money and investors' funds.
So we've mentioned the diamonds and the rocks. How do you differentiate between the two?
I think this sector in particular has all types of companies, from ones that are just starting out in the cycle to ones that are ending. But in many ways, this sector reminds me of the mining space. You have a product which has a limited lifespan in terms of patent protection, and after that, you either need to have other products stepping up to the plate, or you're a one-hit wonder. So is it a one product or a multi-product? Where's the research and development? And after the patent runs out, is there something else to take the cash flow, take over the cash flow, or is there going to be, as they call it, a patent cliff once the patent runs out?
How long does the patent usually go for? 20 years or more?
It's about 20 years, but don't forget that the whole FDA process usually takes 8 years or more. So it can be sort of 10 years on the commercialization
And I've seen
side.
people, I mean, you have as well, we've interviewed them over the years, where the companies look really promising and the markets really like them, then the FDA's come out and said, yeah, no passing for you, and bang, down goes the share price.
And it's a binary outcome. If the FDA says no, you've lost access to the biggest market in the world. But also when you have a look at this space, the timeline is so long, and it's very easy to fall in love with the stories in this space because they are very powerful stories.
Okay, you've got one you really like. Tell us the name and tell us why.
This is Mesoblast. I call it the
Great name, isn't it? Mesoblast.
I call it the stem cell company that works. And look, it's a feel-good story. Hundreds of kids already have had their lives saved by the technology that we've seen Mesoblast come out with, just through the compassionate program and the FDA trials. And this is because of the acute host versus graft disease. Now, this happens when children who have cancer get bone marrow transplant and their own cells fight back. So it's called host versus graft disease. And one of Mesoblast's products helps deal in that area. So that's an exciting area. But it's not just oncology where Mesoblast has work going. It's things like cardiology as well as degenerative diseases as well.
Yeah, the share price here, it's up 72% percent or so. What kind of time period return? Well, over 1 year. So is it too late to get in a stock like this, Julia?
Look, I think the exciting part of this is that there's 3 tier 1 projects which are very late stage, which means they're almost at commercialization.
So the third tier is the best tier to be in.
It's the best tier. It's the tier that's most likely to make you money and not lose your money. Whereas if you're in that first trial one, it's a long, long journey. But look, the journey is being done now, and here it's about investors being rewarded for waiting with the company. But look, I like getting in just as that commercialization process is about to take off. And this is a company that has probably reached peak research and development now, and it's going to start bringing in revenue growth.
Okay, now we should share with the viewers what you said to me beforehand, because you said, Pete, she actually told me that the stock last week, and it went up 8% today, and you thought I was out there spooking it.
Well, Pete,
I've kept it a secret till tonight.
You said, don't tell anyone the stock tip, keep it for the show, and then I saw the stock jumping up 8% today, and I thought, has Pete told someone?
No, we haven't. But I guess what people worry about is, we get in, and then the market takes it up, and then the FDA might say no. Have you tried, for you to be backing it, it seems to me you must think there's a very good chance the FDA is going to give it a tick.
Well, it's not just a one product wonder here. We're looking at 3 tier 1 products with the potential of commercialization. So if just one of these was a blockbuster, these are huge markets that we're talking about. I mean, heart disease is a huge global market. How many people have lower back pain?
Yeah.
And it's a growing market. So just one blockbuster will be a company maker for a company like this.
Okay, so from my point of view then, you think this is a good time to go into this stock right now?
I think people get really tired going through phase 1, phase 2, phase 3, the long journey of pouring in money and the cash burn that goes with developing a product. And you're at that late stage where a lot of investors maybe have lost heart and there's been problems with shareholders along the way. But we have seen a big Chinese company, a pharmaceutical, Tasly, inject $40 million into the company recently. And with an undrawn facility of $160 million on its current cash burn of about $22 million a month, it has around about 18 months worth of funding, which is nice to see in a company like this.
Big money.
Huge amounts of money.
One last thing, what percentage of your portfolio have you exposed yourself to Mesoblast?
Probably about 3%.
Yeah, and that's the important point. This is not a core investment. This is a speculative one, and people shouldn't go mad with these sort of ones unless they want to take a big risk.
Look, it's at that cusp of bringing in revenue, but because you don't know the growth rates in terms of revenue growth that this company is likely to come out, because it doesn't have a track record, a huge track record, it's only deriving revenue from Japan at the moment through its stem cell product.
Okay, Julia, thanks very much. I'm going to do a quick little education point. I'd love you to listen to it. Now, it's time for my Wealth 101 education tip. Bring on the charts. And the first one highlights, and by the way, this is nearly unreadable, and I know it's unreadable, but I'm going to make it readable for you. The first one highlights lots of assets growing in value between 1970 and 2009. That's 1 year after the global financial crisis. Now, I'm going to pull the blue line out because that's the ASX 200 index. And we're going to pull that one out, and you can see that there. All those little wriggly lines show lots of little crashes, then booms, and crashes, then booms. And what's extraordinary about this chart is that if someone had put $10,000 in 1970 and basically bought like an ETF for the ASX 200 index and just kept reinvesting their dividends over that period of time, that $10,000, despite crashes in 87 and the dot-com crash and the GFC crash, still 1 year after the GFC was around $453,000. I'm going to talk next week about the kinds of investments you could make to expose yourself to those kinds of returns. You won't necessarily always turn $10,000 into 453 grand, but that trend is a long-term one which pretty well I can think you can put a lot of faith in, and we'll talk about that one next week. Now, coming up after break, one of the country's top fund managers will be putting out there for you to understand what he does with his money when he's not investing other people's money, but he's investing his own. Charlie Aitken up next. Welcome back. Well, Charlie Aitken was a celebrated stockbroker, but eventually went into funds management to see if his stock picking could help him create a good reputation as a fund manager looking after other people's money. And he put a lot of his own skin in the game when he started Aitken Investment Management. I caught up with Charlie earlier to get the whole rundown on Charlie and his fund. So Charlie, why did you become a fund manager?
Well, Peter, I'd been a stockbroker for 20 years and I thought it was time for a change. I had some clients who were prepared to back me and say, look, if you want to change to being a fund manager, we'll give you some money to look after and you can go and start that test. So to me, it was a natural progression. You know, it was time for me to do it. My father was a fund manager, so it's a little bit like being a doctor's son, but it was also time in my career. I was 40 years old. I thought I had enough experience and it was time to truly test myself.
For those who don't know, what does a fund manager actually do?
Well, a fund manager looks after people's money. We do it professionally. People give us money to look after. We invest around the world and try and generate good returns for them. But it's really looking after the money 24/7, whereas people may not do that as much by themselves.
I guess it's great when the market's heading the direction you expect, but what about if a market is actually going against you? Trump hurts the Asian market and you're heavily exposed to the Asian market.
No, well that's the true test, isn't it, Pete? So look, obviously the first couple of years for the fund were really good. We had tailwinds, we made people good money. This year's been a lot tougher for us. You know, we're well invested in Asia and Asia's been a big underperformer, so the fund's down a bit this year, which makes you feel a bit silly because, you know, if you just owned Amazon and Apple shares, well, it's just been easy. But where we're invested, it's been a bit tougher. The US dollar's been strong, emerging markets have been weak, the trade war has weighed on us. So some of our bigger investments like Tencent and Alibaba, which I still think are great stocks, and Ping An Insurance, have been under pressure this year. So that is a test. You know, it's a test for your investors, it's a test for yourself. But you know that if you own good companies and they're cheap, you'll eventually come out the other side.
So do you think this is a buying opportunity?
I think there's great value in Asia. Things like Samsung, Tencent, Ping An that I mentioned, Alibaba. I think Asia's very, very cheap at the moment. I think the trade war will pass after the midterm elections. There'll be some sort of deal. And I think the US dollar's peaking right now. So I think the opportunity set in Asia is very strong. I mean, we have investments outside of Asia. We do have some American investments, but they're mainly value and cyclical stocks. But, you know, it's hard when you're getting, you know, hammered every day. But I think there's a great opportunity there.
Well, is there a local stock that you actually like right now?
Yeah, well, I think the biggest holding we have locally is Aristocrat, which is a bit of a growth stock, but it's back to 20 times earnings, growing at 20%, has 70% of its revenue coming from America, recently corrected about 10% just on rotation to other sectors like resources. I think Aristocrat is a truly global leader of its industry that just happens to be listed in Australia, and I think it's cheap at the current price, around $28.5.
In terms of global stock markets, what's the event out there that might be a really big worry?
Well, the event is inflation. Clearly, if inflation is higher than expected, that central banks will have to respond with quicker than expected interest rate rises and bond yields will rise. So, Pete, it's really about the cost of money and the risk-free rate of return. That is actually rising. So there is a little bit of competition to equities to put your money on deposit. You know, you get a slightly higher rate at the bank, your bond yields are getting a bit higher. The biggest black swan event is interest rates rising faster than people expect. That would take heat out of the markets, and it would also drive a big rotation probably from growth to value, or from, you know, big growth stocks to financials and resources and cyclicals. So I'm not bearish, but I think there could be a large rotation over the next year or so as interest rates rise, which are a reaction to the world actually doing quite well.
It's all very well investing other people's money, but how does Charlie Aitken invest his own money?
Well, to me, a fund manager's got to be aligned with their underlying unit holder. So any money that I have is in the fund. Any discretionary money I have is all in the fund. I have no other investments other than investments in the fund, which I think it's the way it should be. If people are going to be good enough to give me their money to look after, my money should be in the fund too. So rightly or wrongly, even I've taken a bit of pain at our, you know, reasonably ordinary performance in the last 3 months, but we will recover that.
Yeah, and one story I've always remembered, that when you started this fund, you sold a very valuable house in Darling Point and put that money into the fund. Is that because you want skin in the game?
Yeah, well, you've got to have skin in the game, but it was also a risk management thing, Pete. I thought when you start a small business, you're not sure how it's going to go. I didn't want any borrowings in my life. So the company that our funds management company has no gearing, and I have no gearing at the moment. I think that it was also, yes, a reason to back yourself, take, you know, cash in your house, put the money in the fund, but it was also getting my own balance sheet in order. I had no gearing when I was starting a small business. And I think that's important. I think it allows you to make better decisions when you're not beholden to anyone else when you're starting a small business, particularly a bank. So look, that's worked out reasonably well. I'm not saying to people you should sell your house and start a small business, but we will buy another house at some stage. But I think it's also about alignment and risk management, and it was the right decision at the time.
Thanks for joining us, Charlie. That's Charlie Aitken of Aitken Investment Management. Well, that's the show for this week. Thanks for joining me. And if you want to get catch up with what I'm doing in terms of wealth building insights each day, have a look at Switzer Daily or www.switzer.com.au. I'm Peter Switzer. I'll see you next week.